I think we're now going to start talking about risk costs. And that is, I think, going to be yet more interesting. And so the question I'd like to raise now is, for each of the models, what are the risk costs? That is to say, not just simply operationally, but because of greater risk that may be imposed on various folks, whether it, moving essentially risk from customers to FCMs to DCOs. What are the additional risk costs? How do you measure them? How is it that you're likely to allocate them?
Bob, if I could just sort of start with the big picture, and we certainly can get more specific after that, but I do believe that there's a systemic risk cost to moving to away from the futures model. I do think that it will result in FCMs electing not to maintain excess net capital because that excess is at risk. That excess can be pulled from them by the clearinghouse. It's a risk that they don't have control over. And so I think you would be left with less well-capitalized FCMs, creating more systemic risk.
Let me ask about that. Right now we have, as you know, our net capital rule. And so I guess my question would be, is the capital that we're calling for under our net capital rule sufficient, or should we be changing that net capital rule to require increased capital?
I saw that in the release. I don't think it's really right on point, though, and I know where you're going with that. But I think FCMs are encouraged. I mean, it's different to mandate it as opposed to needing it for good business prudence practices. I think that the motivation won't be there anymore, and that's not to say that capital levels should be increased or reduced, but I just think the motivation won't be there.
I think what I would add to that is I don't think of, required capital is capital. But required capital and excess capital actually perform somewhat of a different function in the way that they help the clearing members protect the customers against the erratic behavior of other customers, right? You need to be in regulatory capital compliance. So raising capital requirements increases capital in the firm, but it doesn't increase the firm's ability to be resilient to losses that would eat away at capital. You need excess capital to be in the firms, no matter what the capital level is, because they need to be able to maneuver and cover losses and still be in compliance with regulatory requirements. So there still is a need for it, and I think in a model where customers are less incented to care about the credit risk worthiness of their clearing members, and some of you have said that you still would be very concerned, so that is good. But if there were an environment where customers were not as concerned about the creditworthiness of their clearing members, I think that does probably result in a reduction in the balance sheet that parent entities would allocate to the futures business, because there's not any competitive value for having it, because you're not going to necessarily attract a different class of customers because the customers are less attuned to the balance sheet of the clearing member.
But I guess the question I'm asking, the assertion is made that there's a systemic risk that because FCMs are going to be essentially have more capital at risk, they're going to reduce the amount of capital they hold, thereby creating systemic risk. And I guess my question is, if our capital requirements, and for that matter, the DCO, of course, they have capital requirements for their members, are those sufficient? And if the answer is yes, then how can we say there's systemic risk if people meet those requirements? And if the answer is no, then why shouldn't both we and the clearing organizations be increasing the capital?
I think the first line of defense that we should talk about it first is what initial margin requirements there would be, because once we've understood that, then I think the residual risks become clearer, become sorted out. So if we start with initial margin under the different models, we put in our comment letter, ISDA's comment letter, a heuristic, which for the futures model, margins are levied at something like 99% 5-day coverage and so on. Moving to a 99.9% confidence coverage, we think will increase margins by about 60%, 60-70%. For rates, yes, this is just for rates. I think for CDS, it could be more than double. I'll let Chris talk to that. But going back to rates for a moment, the 60% increase is somewhat demonstrated by the CME's current margining system, the one they're about to use, which is very similar to LCH's, but which charges, where the 60% number is demonstrated that's 3 points is the margin for a 10-year swap, and for LCH it's 5 points, which is I think, very much in line with the claim.
And is that essentially going from a 99 percentile to a 99.9 percentile?
Very much that. It's slightly different, but very much that.
But is that to accommodate which model? The going from baseline to LSOC or going
Yes.
from LSOC to SEG?
To also.
Going LSOC to SEG, I don't think is any real change in IM requirement from LSOC to complete SEG or full SEG.
Yeah.
But going from futures to either of the two is a 60% increase as far as we can understand it.
Well, that in itself is an interesting statement about the degree of mutualization of risk that is occurring. So, you just in essence, then you're asking us on this side, I guess those of us on this side of the table would benefit in the short run by having to put up less collateral. But what's being said, if our transactions had to be margined on an individual basis, it would require that we put up 60 to 70% more, which says that then the real risk of that transaction is 75% more than what we're collateralizing. So in the event of a default, not by us, but by another counterparty potentially, they will be under collateralized relative to what their individual transaction would require, and then that potentially could work its way back to us.
It's true, but here's the rub on that. The diversification in the client account is so great across customers. In the futures world, in our futures client account, one individual client does not comprise very much at all of that account, and so the fellow customer risk gets shared across so many other clients that it's de minimis a loss.
But that's the theory. That's the theory. But again,
yes,
that's the theory, and I believe it's the CFTC's own work that demonstrated the reduction of that client collateral in the case of Lehman. So that's a theoretical diversification.
Oh, it's totally theoretical.
So
Absolutely.
we have to be really careful.
But the
Absolutely right.
exposure went down in Lehman too. That's the thing that everybody's leaving out of the picture. You want that to happen. That's part of why the risk management regime works, is that people have an incentive to leave a firm that is appearing not to do well.
Yeah, but
And they take their exposure with them along with their collateral.
But Kim, are you guaranteed that the exposure that will be leaving is not the exposure that causes the default?
Let me just continue what we found was that the closeout cost in the futures model was the most expensive lot. I mean, the closing out a client account in rates could be extremely devastating to the market and would cause, we think, losses, replacement costs of the order of 6 to 10 or more times the amount of fellow customer risk. So there'd be really significant losses, and any way they can be avoided would be beneficial to every participant in the market. To think of a large financial end user losing all its hedges, it could be catastrophic to the taxpayer too. So we're really concerned that there is a way to port, and any way that clients can port out, or any model that provides that is superior than one that doesn't.
So,
Well, I think that's probably more a matter of perspective. Because not only, again, systematically, if first of all, was that analysis conducted on existing cleared products or prospective cleared products? Because my guess is prospective cleared products are going to be more volatile, and the multiplier is probably going to be in excess of that 60 to 70%. Again, meaning that, let's say that it goes to 100%, that the market
Yes,
mechanism
for swaps it's about 60. For CDS, I think you're measuring 100 and something.
CDS, we talked about.
Yeah,
even
so
And swaptions even more so. You're
Yeah.
right.
the
Absolutely.
more non-N you get, the bigger the number.
Right. So again, we're inviting then counterparties to participate in a mechanism that requires that they not put up enough collateral or capital to support the risk of their standalone instrument. And so again, are we building a house with toothpicks, or should we be looking for something that's going to give it a little bit more strength when the storm comes up? And maybe these transactions should be required to stand on their own in terms of the collateral that's put up, and that way then you spread risk appropriately. You don't encourage an institution to take more risks than they should because they can.
No,
Yeah.
but I think
Pay
totally
as you
agree.
play.
But
Yes.
I
have a
think
question.
we agree with you. The important building elements here are both to have the appropriate level of collateral, but also to have the mechanism to ensure the portability. The portability is what's basic. And I think Oliver's point was not, I would prefer it if it was the baseline model, but it is, if we do not have portability, the cost associated with the unwind will be higher than the fellow customer risk probably. I'm not saying that we prefer that. It is fundamental that we build the portability and have a structure that actually allows the portability to take place. That is the only point. I think if we were to summarizing what Oliver was saying is that the not having the additional pool of funds that are associated with the fellow customers means that we definitely need to actually margin from a CCP perspective at a higher confidence interval. That will differ depending on the asset class you're looking at. Some of them, at least based on the existing pool of trades, it could be manageable like 60, 70% like in rates. We'll talk about 3 to 4 times the amount that in credit. And the more we get to instruments with fatter tails, the higher the number is going to be. I think that is something that clients need to be cognizant of. I think, like you said, a lot of people might see that as an actually very reasonable trade-off, basically, and accept that. But those are, I think, very impassionately kind of the choices that we have to make here.
So
Let
does
me
that
press
mean
on that
that
point
the
just for a
luxury
moment.
car.
Let me press on that point just for a moment, because I've seen from the comments some folks talking about increases in margin. I've seen folks talking about increases in guarantee fund. And so what I'd like to get to is how would you determine how much additional margin? How would you determine how much additional guarantee fund? And also, very importantly, how would you determine the mix? In other words, are the numbers we're talking about A or B? Is it both additional margin and additional guarantee fund, or is it A or B, or how are you going to combine them? So
It's a balance. It's a balance. And I mean, I don't know that we can give. I mean, certainly, in our comment letter, we went through and we took every one of our existing portfolios. Okay, and we took them at the 99% confidence interval they're in today, and we scaled it up to 99.9 to show you what the difference would be based on a factor. And if a factor of 1 is 99%, the average for CDS at 99.9% was 3.7. So a 270% increase, if you want to think about it that way, on average. Some are higher than that. But as we walk through those pieces of that puzzle, there are other considerations that this agency doesn't impact. As we relate to our membership at the end of the day, and the constraints that they have placed on them by other regulators that may have some insight, some control over. So to give you an answer on that question of what it would be, to determine that balance, I got to figure out what bank capital charges may be for some of the entities that would be faced with that in order to give you an adequate picture at the end of the day. Or we can just say, you know what? We're going to reduce the guarantee fund because we're going to go to 99.9%, as other models represented here have. And at that 99.9%, we're going to have a very limited guarantee fund. So that mutualization risk, like If initial margin doesn't cover it, and we can show you all the models there and these products that historically haven't been cleared or have just recently begun clearing, and say this is it, and we believe we're right, and chances are we are. But the cushion that you have in the intermediated model that we have today won't be there anymore. So that's the trade-off that you're going to make in that type of assessment.
So here's I guess-
And that is an important, that is a mixed decision, and I agree that you can make different mixes and make them work. And you can't really call it right now until you see the portfolio and the conditions and the regs and the capital rules and everything that you're gonna be facing. So nobody can make a call on exactly how they're gonna do it.
And I'm
The
understanding.
problem-
just
the problem
a
is if
second.
you go-
And
if
I'm
you go
understanding
too
part of
far
that is
in
because the
one
bank
direction.
regulators as well.
No, but,
If you go too far in one direction, and go higher on the margin, you can do that. And you could go lower on the guarantee fund and up to a point that is fine. There is a point where I actually think going below a certain level on a guarantee fund is improper systemic risk containment behavior by a clearinghouse, because a margin is based on an estimate. It's based on your statistical assessment of what the worst case loss is going to be tomorrow, and it might not be that. It might be worse. And so that is why margin needs to cover the tail risk, or the guarantee fund needs to cover the tail risk event that could happen beyond the margin. I think no matter what kind of statistical estimate you use to cover the margin.
But we
Model
use
risk.
different. Hold on,
I
but
quite
we
agree.
use just to explain how we got here. The mix we chose, for example, on the credit side, it was determined when we had only direct clearing members and not clients. Because of the fat tails of the credit asset class, we initially went with more mutualization. That as a result increased the guarantee fund contributions and decreased the initial margins. It is very difficult to pass these costs on the moment we introduce clients that actually are not exposed to that mutualization. So perhaps the model going forward will be one that's going to err on the side of initial margin versus guarantee fund. That is actually consistent also with the way I think also international regulators are treating the guarantee fund contributions of clearing members. And if the current proposals under Basel go through, they're going to make it extremely punitive to actually have guarantee fund contributions. So the incentive will be to reduce those, and therefore you will see a very large increase on the initial margin levels.
I think the concept here, to make it simpler, which is what we've done, is this picture represents the amount of margin, the water that needs to exist. Okay, if you take out the mutualized part, you end up with what I'll define as an hourglass, right? And in the hourglass, the top part is what the buy side pays, and on the bottom side is a guaranteed fund and the CCP contributions. Okay, so a lot of the conversation we usually have talking to clients and such is that how much IM do you have to post? When we get to, we have to come up with a system that's efficient for, we have to have strong FCMs, we have to have strong CCPs, we obviously need strong investors. We have to come up, and obviously Basel III is important. The overall cost you have to, and I think John alluded to it, is you have to pay for your risk. We're all kind of like storage units. And if you have a lot of furniture, you got to get a bigger storage unit. So if you're bringing in a lot of directional risk, you're paying much higher IM. If you're a well-valued trader, doing curve trades and things, your margin is not nearly going to be as high. But the real decision, which is the hardest decision, and unfortunately I can't give a definitive view, is that the cost to the market participants, the risk takers or the risk makers, has to be viewed as both the IM plus the capital cost that the FCM or the CCPs have to charge. Because in the long run, if we have, let's make a bad example, but if you have two FCMs that are willing to basically pay the guarantee, put a lot of money into the FCM, but they're materially cheaper because they're not charging for it, and thus all the buy side is paying is for the IM, then you're going to have potentially all of the exposure run to two, very cheap FCMs, and then you're going to have not mutualized risk. You're going to have two very large ones. So the fact is, well, Barclays wants to be very large in the clearing space and important. We need other dealers, my friends on the side, to also be very strong FCM and clearing dealers to have a strong, contained, and protected capital markets.
Bob,
Follow up on that point, because essentially the point you're making is, look, if you're taking part of the capital pool out, namely the potential collateral of fellow customers, you're saying, hey, that's going to have to be replaced somehow. And so here's my question. When we're saying that you're going to go from 99 to 99.9, is that tied to an estimate of the amount of collateral or the amount of capital that you would have to meet a default that you'd otherwise use, or is it just simply, well, we're just going to go up to the next level of magnitude, 99 to 99.9? In other words, are you saying, okay, here's how much we have, here's how much we expect from fellow customer collateral, that's going to cost, when we do the Lamfalusi calculation, that's going to cost, we're going to have so many $1 billion less in collateral available, so we have to make that up, basically rejigger the model? Or is it just simply, okay, 99 to 99.9, because that's the next level of magnitude?
I think the original model was always to have a 99.9, and that a defaulter would be paying for their own risk. We split it up so that the mutualization covered some of that. So in my I'm paying a certain amount, and then in my guarantee fund contribution, I'm basically paying the rest, so that in total I reach a 99.9 kind of confidence level, with mutualization sort of ratcheted so as to cover the model risk that Kim was talking about. For clients, I think the fellow customer risk covered that tail, so that they too had, not on a pay basis, but some potential loss basis, covered that same sort of tail, so that the residual was very, very little too. So in a sense, there was mutualization in the customer book that also effectively took them to the same level. I think it's not so much 99.9, but it's sort of covering extreme but plausible market conditions. That was the notion.
If the customer happens to get wind of the FCM's weakness because they're looking at CNBC
sure.
and they pull the money out.
They pull the money out, and then
Money out without taking their exposure.
But right, so the exposure comes down as clients perceive that an FCM is getting weaker, and they pull out their risk.
But I
It's
guess
the
what I'm
other
saying,
client
that's,
defaulting's exposure that you're worried about, not the one that's porting away.
Right.
So that's the fundamental point here, and that is why we, in our public letter, said you cannot rely on it. Yes, we said it's zero, and I know everybody will disagree and say it's probably not zero, but it's probably not 100% either. But the only thing I can make a conservative and realistic assumption is that it's likely not to be that. And yes, 75% of clients went, and I take everybody's point, they took their collateral and they took their exposure. But what we're talking about here is the client that didn't take their exposure and they went under. And I'm relying on that 75%, 80%, 90%, whatever, to actually close that out.
I think
so
that's
what,
right.
What is that number, is the
think
question.
I think that's right, but I think that a CCP seeing that an FCM is losing all its clients and potentially leaving one rather large one will super margin that account to make sure that it's now at a 99.9%. The super margining now taking the place of fellow customer risk. I'm speaking for you, actually.
But we're making the assumption that 75% is going to move at that omnibus that's moved at that level. It's really uncertain how big that client level is going to be. It's a variable. We don't really know how large it's going to be. It's a function of the amount of risk that's been put in the storage unit. So whether it's been moved or we're just not certain how large it's going to be. I mean, I know there's been estimates from ISDA. Each dealer has estimates and stuff, but it's uncertain how much is going to come from there.
Is the safest assumption not for a DCO to say, I can't rely on it, rather than making all these theoretical, nebulous sort of predictions of what you may have? The safest thing, to John's point about risk, systemic risk reduction, we assume zero, and if there's anything there, great, we'll use it.
Okay,
in
so
an omnibus account. But if it's not there and you don't factor that in.
As a clearing member guaranteeing my clients, I would definitely prefer that.
And so, Dan, you assume zero as
Yes.
the percentage of what might be available.
And just to add to that, so therefore margins and guarantee funds would not change from omnibus to LSOC in the
So
LCH swaps model.
Kim, I think you're saying, and Chris, you're saying margins would change. And so I guess my question would be, when you're doing your models, and I don't want to ask you to give sensitive information out, and so I understand that you may need to give a somewhat vague answer, but I guess my question is, are you assuming 100% or something less of that fellow, in other words, essentially the diversification effect, are you assuming that that's there to an extent of 100% or something less?
I'm not entirely sure I understand the question. Are you asking me, when we do our calculations now on what our guarantee fund should be? Is that what you're asking me?
Yeah.
We do stress testing that is kind of independent scenarios for different sets of products, kind of combine the worst case losses across the different asset classes. We take into consideration the resources that would legally be available to us to cure that default. And then we look at the gap and we set the mutualization package to well more than cover that gap. But I mean, at least at the minimum, the best practice standard is to be able to cover the worst case loss of your worst counterparty in systemically bad conditions.
And what I'm asking, though, is you mentioned the resources that are legally available to you.
And
So
that
here's the thing with the fellow
and that
customers.
That would change in an LSOC model. And our estimates of what the margin increase would be likely to be are, if we did it with all margin, you'd have to make a mix decision, are not unlike the estimates that Oliver already talked about.
But the question I'm asking is, under the futures model, under the current model,
Okay.
you mentioned that you're going to look at the resources that are legally available to you. So one thing that's clear is under the futures model, all of the fellow customer collateral that is there on the day of the default is legally available to you. But in comparing what is there as of the day you do the calculation to what you expect would be there on the day of default, are you assuming that all of the collateral that's there on the day of calculation, the non-defaulting customers, is going to be available to you on the day of default?
And I guess here's what I would say about that. We could take a haircut on it. We don't, because we would be making an assumption about the collateral. It goes along with the exposure. And so we are making the assumption that we have the right amount of collateral for the exposure that we have at the time under the set of circumstances that we're margining for. And if we do this every day, and if there is a change in the amount of collateral we have, there's also a change in the amount of exposure that we have. And when we assess whether we've got sufficient resources in our package, we take both of those things into consideration. And so we would have to be making assumptions that would be, they would be guesses, right? On what you were assuming you would lose in terms of the exposure versus in terms of the collateral. They go together.
So you're assuming 100% of the fellow customer collateral that's there on the day of calculation would be there on the day of default because, as I understand it, you're calculating every day, and so if customers start essentially melting away, you'd be changing those calculations. Here's my question on that score. So you would be then asking for additional guarantee fund contributions at the same time that you have a member that is essentially on the downstroke, which might correspond to a time when markets are a little bit, more volatile than usual. Isn't that pro-cyclical?
It could be. But we also look at, if the exposure profile changes, there are many things that we can do. We can change margins in general. We can change concentration margins in particular markets, with particular customers, with particular clearing members.
But wouldn't you then be trying to get money out of the same clearing member? Wouldn't you be then trying to get money out of the same clearing member, which is currently on the downstroke? I mean, in other words, using Lehman as the example, and happily they didn't have a default by a customer. But essentially, so during that week, 75% of the customers who were there were, of course, going to other FCMs. Assume, contrary to what the experience, that they had some customers and some big customers who didn't, who happened to be the ones who were defaulting.
Right.
Your ability to get additional collateral out of Lehman, do you think that?
Yeah, well, that is a good question, and that is why we did not just sit on our hands the week of Lehman, and we made sure that we were helping to find solutions for people to move their positions. The very best outcome in any of these situations is for customers to be able to exit the failing clearing member before there is a problem. We very actively do that. We actively solicit on an ongoing basis a set of what we call white knight firms who stand ready to look at situations where we might need them to take kind of a bulk transfer of clients. We have a stable of people that have offered to look at a portfolio if we ever need bidders. We have a stable of white knight potential bidders who will look at a portfolio if we needed to sell one on short notice. We actually liquidated the Lehman House portfolio in basically 5 hours because we found out very late one night that it was not going to be part of the bankruptcy transaction, the purchase. And by 8 o'clock the next morning, we sold the entire book. And people got the portfolio information at 2 o'clock in the morning. So we're able to marshal the resources and the capacity to risk manage situations as they're occurring very, very readily and very actively. If we just sat on our hands, you would be asking me some really good questions.
Could I just maybe ask a question of the FCMs? If there's been a default of an FCM and a client, and there are a bunch of clients who wish to port from the defaulting FCM, or just prior to it going to default, to yourselves, are you more likely to accept that port on a 99.9% in confidence interval or on a 99% confidence interval where they're paying for the margin themselves? Because if you take the 99, you're going to be paying a higher guarantee fund, which will also have capital charges under Basel III. So what would the FCM do in terms of giving a higher probability of portability? Which approach would be preferable?
The 99.9.
Agree.
Yeah, higher too.
Rest my case.
I mean, you're asking us to guarantee risk in an extreme, but extreme conditions, and we would like margin to cover that.
But
Whether it was the minimum or not, we would want it.
But then in general, I mean, you take the portfolio at the level that you do an evaluation that there is adequate margin coming along with it.
Yeah, good. But we made the assumption at the beginning of this panel after lunch that these products, the OTC derivative products, had more price volatility. That's an assumption than futures, and it's great that it kind of flowed smoothly in futures. At the same time that Lehman was melting and this stuff was happening behind the scenes, the bid for various OTC derivative products, particularly in credit, was not very good. Okay, in fact, it was almost non-existent, or it was one by one for single name CDS. So the fact is, I'm not convinced that the ease of finding the white knight on OTC derivative portfolios will be as easy as it has been in futures.
I agree, Ray. I'm just saying it's the probability. Sorry, Richie. I'm just saying the probability would be higher that you take something with a higher confidence interval, but you can't guarantee that.
But I think that's an excellent point that you're making, Ray, because I think you started off today, Bob, by drawing these parallels so we can just make sure we're having apples-to-apples conversations. And Kim, I have no doubt that you all handled the Lehman situation fabulously. But I do think that we're just not comparing it to what the cleared swap portfolio will look like. It's going to be a much different risk profile, not just price volatility, Ray, but this liquidity situation that I think we talked about. Someone drew out that distinction before. So I think we have to go back to what did LCH experience, how did that happen, over what time period, because that was real, and that's the type of portfolios we're talking about. So I do think, if you string together some of the comments that John made about the subsidization that we see in the futures model, and then maybe that's acceptable with these, the type of products we're talking about, which have smaller volumes and less liquidity issues than swaps. Maybe that's acceptable, but I do think we have to look to where. We've seen the precedent with LCH in an LSOC environment with the higher IM, with assuming that there'll be no client buffer there, and if you have to pay for the risk, you should. And then the only other point I'd add to that is that higher IM has another effect, which is it's an incentive for clients like ourselves and others to keep tidier books. So if you want to get that IM back, you just go and do more tear-ups, and you actively manage line items. So you're not consuming all of that initial margin out there. So it has actually a very positive, ancillary effect to managing risk, and it's good for the system.
Richard, I just want to make sure I'm understanding. What I think I hear you saying is that while in Lehman there was that 5 hour and, the liquidation and the ability to sell the portfolio, your concern is that there is a higher probability in the swaps world that there may be portions of a portfolio that will not transfer anywhere near as readily. You got to speak into the mic.
I agree with, yes.
Maybe to give some color of how the Lehman closeout happened for the interest rate swap book. I was involved, and we had a holding period, In the first instance, you take the 66,650 trades or whatever it was, 9 trillion, etc. I'll not bore you with the detail, but we break that down into risk, trading risk, into delta pillars. We traded, excuse me, we executed in the region of 150 large hedge trades across multi-currencies, and that macro hedged the portfolio probably within the first 2 or 3 days. And then we didn't, using Kim's phrase, we didn't just sit on our hands. You have to keep micro hedging, dynamically hedging the portfolio. A portfolio of interest rate or credit derivative swaps is a living organism. It changes shapes and moves by the second. So you have to keep micro or dynamically hedging that. But once we got to a point of low volatility in the portfolio, so minimal variation margin volatility in the portfolio, we then enter into the next phase, which is an auction. I think it's really important. We actually executed real trades. We didn't auction live risk. We hedged the portfolio within a degree of tolerance. Then we broke that up into chunks, and we gave that back out to the non-defaulting clearing members for them to take the portfolio in, all the tens of thousands of trades, revalue the portfolio against their own curves, calculate the risk, any novel positions in there, curve risk, reset risk, etc., and then they made a bid on it. And then we accepted bids, but this was over the course of a 2-3 week period. So yes, in the first 2 or 3 days we'd hedged the risk, but we still had this living organism, for want of a better phrase, over a 2-3 week period whilst we auctioned the positions off and transferred them to the non-defaulting members. To give you some context, that was all within, we gave back about, I think it's about within 40% of the initial margin, so we gave back about half of the initial margin back to the Lehman Brothers estate. So the end result was there was nobody impacted. None of the clearing members were impacted by that or any of the clients.
Well, I think it's also important to Richie's point is that, and to Ray's point, that the porting of these books could be much different because today our swaps are done out of a different entity than the FCM with our dealers. Now you're going to have those transactions all done with the FCM. A client may reach its exposure with an FCM much quicker now on those trades because now you have futures and swaps that may need to be ported, and it may not be able to go to just one FCM if that FCM doesn't want to take on the exposure to Fidelity at that level because it already has swaps and futures with us. So we may reach our credit levels much quicker with an FCM and have to port to more FCMs than we did in the Lehman situation.
So to that point, we will have limits, portfolio limits for all of our clients. You're likely to have your margins potentially going up at that period, more payments. So, the question is, can you take it all in? And you have the operational issues of as I stated earlier, operationally, if there's large hundreds or thousands of line portfolios that need to move, do the FCMs, do the CCPs have the manpower to basically move thousands of line items in a 1, 2, 3 day period? I can't tell you for all the people. I'd love to be able to tell you that Barclays can handle every line item of the clients represented over there, but if it's a stress situation, I don't know that we can do that on a 1 or 2 day period.
Well, you guys have the most experience of that now.
We're doing the best we can. I mean, we're all trying to build straight through processing, but let's be honest with reality. I mean, taking in to the point of my fellow FCM colleagues, we'd love to look at the portfolio and say this is a portfolio we like. It's short, it's long, all this type of stuff. But if you have a 1,000-line item portfolio, you got to bring that in and also process it operationally. There's a lot of stuff going on.
No, but that's why I think if clients probably want a lot of options as to where they're going to go, probably pre-default portability is the answer. Post-default, I think, is going to get a lot more complicated.
Speaking of options, actually, what I'd like to do, and at the risk of complicating this yet further, I want to bring back our discussion of optional models here. Because I guess my question, we were talking about going from 99 to 99.9 and or some increase in guarantee fund. So let's say instead we do an optional model. And let's say, folks representing 50%, 60% of a book decide to take that optional model. So it seems to me there's two questions. What would be the impact? We already spoke about operational costs and what would be involved there and what folks were already incurring. So let's, for the moment, put those operational costs off to the side. I want to simplify this a little bit. Risk costs. How would you impose the additional risk costs on the people who are taking the option to have greater protection? And what would be the impact of risk costs on those folks who don't, to the extent that having the people who are looking for the greater protection, their diversification is now walking off the scene, and so you may have whatever's left in my hypothetical 40 or 50% of the book, which is less diversified because these guys who probably will tell us that they tend to be the less risky of the customer base, they're walking off. So what are the impact, I guess, risk costs on them, and what's the impact risk costs on the rest of the book if we were going to, say, an LSOC model?
Fundamentally, we don't believe that that client mutualization layer will be that. Now, we know it's probably not zero, but we make that assumption. So just to be crisp on this, the margins would be the same, and the guarantee fund would be the same. We make no distinction.
But Dan, you guys offer an option, right?
We offer options, but the margin is the same under each option because we don't rely on any client mutualization under any of those.
But would you expect when many clients, thousands of clients come into the space, which one do you think they'll choose?
The one with better protection for the same price.
I mean, exactly. From our perspective, that's the answer.
But if it's the same price, why would anybody take anything less?
Let me try and answer Bob's question. It seems if the quality of the fellow customer risk, that mutualization shrinks, then the DCO, the CCP, will have to increase the margin levels from 99 to 99.34, whatever it is, to make up to the same level of security for the DCO, which just means that they're at more risk with more money, and it's looking less and less attractive. I don't know why everybody wouldn't move now to the legal seg model, and I don't see the value of offering the optionality in that case. I think that there would have to be a migration. I think it would just be a natural economic affair that everyone would migrate to the legal seg model.
Well, but there's the
I mean, it's
risk costs and the
hypothetical.
odds costs. There's on a risk cost basis, if it got to the same place, then I would agree. People would tend to choose the greater protection for the same price. But there's also the operational costs, and I don't know if those outweigh it for people.
But Kim, could you do it? You couldn't do it even at a different price. If you have 5 clients, 0.9, the fifth one gets 99. Well, who's going to pay for that difference?
Yeah, but the biggest cost, as was said here, is the movement in IM going from 99 to 99.7. There's no way the operational costs are going to come anywhere near that. I mean,
Plus, we said there is none.
I think, talking for
Not everybody said
Kim, I think Kim was talking about.
And just to be clear, what I'm saying is analytically, I'm not sure that the operational cost is changing it. I guess what I'm trying to get at and but again, tell me if I'm going down a bad path here, is that if the thought earlier was, and I think there's this general thought, let's offer options. Those who want better protection pay more. Those who don't want to pay more get lesser protection. And I guess what I'm asking is, as a practical matter and as a logical and economical matter, because of the risk cost issues, because I think, and tell me if I'm wrong, risk cost depends upon diversification. If some large portion of, not the number of customers, but the weight of the customers, the weight of the margin, if you will, goes off and is protected individually, then are the folks who want to opt not to pay more really going to be paying less? Because I think the risk costs then would be permeating throughout the account. But please, somebody tell me where I'm going wrong.
I cannot. But I think Kim was referring to the option between the futures model and the full seg model as opposed to the complete seg model. And I was referring to the option between the futures model and the complete seg model, or the LSOC.
Which one is, okay, LSOC?
LSOC. So I think we just more or less agreed. But that's why there are operational costs, because he was referring to the full seg.
If I can, I may be missing something here, but if the margin is commensurate with the risk of a client's portfolio, and a client opts to move into one seg pool versus another, what remains doesn't change in terms of the existing pool that's losing it, because if it's got a lot of risk, it's taking a lot of collateral. If it's got low risk, it's taking low collateral. So I don't think it's going to overly impact that. And as far as the cost, I mean, that's $1 and cents cost for moving it into an option where you can get that better protection. So I'm afraid we might be combining two separate issues here. And one is the cost of having that optionality in terms of pure dollars and cents versus margin to protect each client or every FCM and therefore every participant to make sure that the client is properly margined.
But your assumption here, and this is the assumption you're making is that each client is providing sufficient collateral for his or her individual position. And as I understand it, in the futures model, each customer's position is guaranteed partly by that customer, partly by the capital of the FCM, and, say it quietly, partly by the fellow customer collateral of that FCM in the event that there is a default by the FCM. And so if that's
Caused by another customer.
I'm sorry?
If the FCM's defaults, caused by another
FCM,
customer.
absolutely. But the point is, to the extent you're relying on fellow customer collateral, then essentially part of what's meeting it, that's where the change is. Part of it is the fellow customer collateral. You know, if you're not relying on it, then there's absolutely no cost, and that's Dan's position.
I think Stephen's point is right. If you're charging 99.9 in one account, 99.9 in the other, if you're charging different confidence intervals, that's when you get the situation you talk about.
Bob, I think you hit the nail on the head, and I think, you know, running from the LCH approach, which has zero effect to the fellow customer risk, to I think what Oliver was saying made a lot of sense, that as that diversification component exits the futures model, the margin level will have to go up from 99% up to 93, 94, 95, and as that increases, those people will jump out of that bucket into the LSOC bucket because they really will not be saving anything and be taking on considerable risk.
But why is the equilibrium when they've all moved? I mean, couldn't there be some point where it goes from 99 to 99.2, and at that point they're like, okay, well, I'm paying a bit more than I was, but it's still better than 99.9, so I'm going to stay put.
It absolutely could do that. It all depends on what happens to the exposure profile of the pool.
But the thing is, it's going to be very difficult to have these two to have clients that are margin at different confidence intervals coexist in the same pool. I think it's going to be very difficult. If you take it to the extreme cases that there's only one client left that is margin at a different level, you're going to have a deficit. You're going to need to have the same confidence interval for the whole account. Either these funds are there or these funds are not there. And I think it's going to be very difficult to have this hybrid that some people choose to pay a little bit more and some will not, because you don't know what mix you're going to have of clients.
Well, don't you FCMs do that anyway? I mean, it sounds like really you should all be margining your customers to 99.9 because you don't get the benefit of cross-customer risk, right? One of your customers defaults, you don't go.
No, it's the CCP level. At the CCP level, I'm saying they wouldn't want to have the certainty that when we go under as a result of a client default, there is going to be a guarantee, effectively, that there's going to be enough money there. But that's the problem. So, but if at the end the only people that are left there are actually is one client that was margined at 99, you just have $1 deficit.
Right.
What do you do at that point?
But Thanasis, I mean, if you got there, the CCP would be taking some action because there is no diversification in that pool. So,
practically speaking, do you guys really do that at the CCPs? I mean, how many of your FCMs are you super margining at the moment?
How many FCMs are on super margining at the moment? Maybe like 15.
Yeah, I
what
think
you're saying, Kim, is that when you say you're taking action, you're basically moving from kind of this formulaic approach that we had to something that you're moving from 99 to 99.9 effectively. You're moving that client up. That's what you're effectively doing by taking action. You're charging higher margin at that point.
And certainly through the use of concentration margins, Rupert, you would, those exist and those are active today, and we collect those, given the position that we hold for that individual. So they're active, and I would, roughly say the percentage of members that are paying that at the moment inside of ICE Trust is probably close to the percentage that Kim just gave you inside of CME.
And just now might be a good time to mention, we had put in the rule, I think it was 2213, some specific provisions noting that DCOs we wanted to make sure that it was clear that you had certain tools that, and that may have been belt and suspenders, that you could require individual FCMs to collect additional collateral from individual customers, or individual FCMs to put up additional collateral from their own funds that would be free for you to use. I don't know if, I hope
We already have rules that allow us to do that.
and so hopefully that is a helpful tool. Yeah, and I'm not surprised that you already can. That is a helpful tool for addressing this, so that there is a closer tie between who is in fact imposing the risk and who in fact is paying for the risk. Does that help at all?
Well, I think you're codifying in the regulations what's already in our individual rule books today. So, from the standpoint that there's no path to escape, I would say that that is helpful from that perspective.
And just to be clear, that essentially, to the extent you do that on an individual customer basis, there would be greater margin that's accessible to you even under LSOC. And likewise, to the extent that you collect the money from the firm, again, that is additional collateral that's available to you under LSOC. In other words, not just simply under your current rules, but even with LSOC, you'd be able to get additional pinpointed protection, if you will, pinpointed collateral.
As it relates to granular position, yeah. Bob, are you at all concerned about, we talked a lot today about portability and making it the ease of portability, and I don't think anyone disagrees with that, because it is an effective tool, especially as Thanasis mentioned earlier, on a pre-default basis, to make sure we understand, Ray's analogy, what we're putting in that cup and what we're going to manage in those points in time. But, if we look at it from a more holistic perspective, and I don't want to spend time getting into membership requirements and the rules that you've contemplated there, but as it relates to that, one thing that the fellow customer risk does introduce is it does make it incumbent. And I appreciate Richie's point, and others have made the point where they don't have the tool set to see, exactly what their FCMs have in their book. And certainly there are a number of us that spend a lot of time talking about what unencumbered capital may look like, and if we could ever get to a world where that type of information become more public and things of that nature. But nonetheless, the fellow customer risk, there is an obligation that there got to at least be some recognition and concern that could dissipate, not necessarily from the sophisticated folks in this room, but they don't represent exactly all of the buy side that we have to deal with, or all that would take some interesting position, to make certain they understand who they're doing business with. If you protect them, if the protection is all the way around and we don't care, are we inviting more of that? Have you thought about that as we went through the creation of that?
And the answer is yes, and I guess I would have a couple of responses there. First, as Jim has pointed out to me, and I imagine will continue pointing out to me, the protection we're dealing with here, that we're creating with LSOC, is not perfect. He's pointed out a number of ways in which it falls short of perfect.
It's the only agreement we've had in the room today.
I'm sorry?
That's the only agreement we've had in the room today. So.
And so we've designed, again, at least from where I was coming from, I intended to design it with a lot of consideration of costs and benefits, and aiming to achieve the greatest level of benefit at the least level of cost. But in doing that, you end up at least sacrificing some benefits and achieving less than perfection. One. Two, even if we had achieved perfect, something perfect, I don't think anybody on this side of the room or anybody in that kind of position would enjoy the kind of roller coaster ride that is simply guaranteed if your FCM happens to become insolvent. Indeed, as I've said repeatedly, I am not prohibiting you from liquidating all the customer positions of that FCM the moment they become out of good standing, because again, that, from where I'm sitting, has to be your right. So again, in short, what I'm saying is, am I changing the level of exposure the folks on the buy side have? Yes. Am I removing their incentive for doing at least some degree of due diligence to make sure that the firms they deal with are not going to go insolvent? heck no. I rather think they are going to continue to have those incentives to avoid, there is a definite residual both in terms of risk and in terms of just simply, I don't think their clients are going to be happy with them if they're dealing with a defaulting FCM, regardless of how well they end up getting protected. I imagine there's going to be some reputational risk there. Again, when you add that to the fact that, as we've discussed, for them to do anything, anything more than a cursory due diligence, a real deep due diligence where you can say, well, gosh, there's a connection between their incentives and therefore they're going to exert market discipline because they're going to do effective risk management of their clearing member. I don't think that's possible. I think, for reasons we've discussed, that the clearinghouses are structurally in a far better position to do it because they get better information, because they have concentration of expertise, because they're already doing it and already have to be doing it in their role as clearinghouses. So to have these guys each create a department of people who would have the capabilities, even if they could get the information, which they can't, to have them create a department of people who have the capability and the expertise that your people have, the people you're already employing, would be imposing a lot greater cost for, I think, very, very little benefit.
I wouldn't. Go ahead.
I know our time is coming close, so I want to just make a couple points. First off, I want to thank you for the great movement from a nothing in any proposal to a very significant movement, and your team, Laura, as well, and we're grateful for that. We view this as a significant first step, and the market's going to have to undergo a significant cost. There will be winners. The DCOs are clearly big winners. But one of the things that we would say is that if you can't get us the protections that we have today for political, for cost, for whatever reasons there are, that the Commission has made some policy decisions along. For example, we get to choose where we clear. We get some choices. And we would argue, at least for pension plans, we pay billions of dollars out of benefits every year, and we want to keep being able to do that. We had protections during the Lehman crisis and the credit crisis that served us well. We would ask that if it will take time, if it will take cost, if it will take political movement in order to get us to full seg, what we have today, that we adopt the policy that the European regulators seem to be going to, which is to exempt pension plans from having to clear until those costs and operational issues and political ones are resolved, so that we don't put the common man and common woman at risk, because that's exactly what Dodd-Frank was drafted for, to protect the common man and the common woman. And what we're saying here is that we acknowledge that all these issues are legitimate ones and thorny ones. Exempt us from clearing until they're worked out.
Yeah, if I could just get back maybe to Bob's point, I don't think that it would be a case where the buy side would stop doing due diligence on FCMs, but I do think that it would become less of a factor. There's a number of factors why they choose FCMs. There's cost. There's a whole bunch of things, but I can't believe it would become less of a concern if they knew that at the end of the day their positions are guaranteed.
I'm sorry, you're saying it would be less of a concern?
No, I'm saying it would be. I would think it would be less of a concern for customers.
That won't happen. We're fiduciaries, and we have a fiduciary responsibility to do this analysis, and we will not stop doing it regardless of what model is chosen. We care about the creditworthiness of our FCM, and we care about that due diligence. And as a fiduciary, if we didn't, we wouldn't be doing our job.
I hope that's true, and for the folks in this room, I'm sure it is, but I'm not so sure that would be true for all all customers. The other thing, just real quickly, before we go, one of the points that that is raised in the release as to why the staff selected this particular or prefers this particular model is portfolio margining. And it seems to me that introducing another potential, having the futures model, the complete legal seg model, and then a securities model, you're just complicating the situation. Maybe I'm not understanding it, but it seems to me you're complicating portfolio margining rather than
Actually, no, because here's the deal. Under an omnibus model, whenever you're bringing something from outside the pool into the pool, you're putting a risk not only for the folks who are trading and are getting the benefit of the portfolio margining for their mixed positions, but you're also exposing to that risk all the other customers. Because again, remember, there's essentially a socialization of the risk. Under an individual customer protection model, each customer bears their own risk, and the other customers are being, if not perfectly, substantially insulated from that risk. And so if I'm bringing in an additional risk that I bear, but Laura does not, then the regulator has less of a concern than if I'm bringing in a risk that I'm also sharing with Laura. Because again, their individualized risk means less concern over portfolio margining.
Okay. I'd like to thank everybody for their contributions. I know extremely weighty topics, particularly for discussion on a Friday, but I am very grateful for everybody's contributions. I would encourage not just everybody here, but all of those who are interested in this topic to please write to us. As Bob has pointed out, the document has not made it yet to the Federal Register. Is that correct? Or hopefully it'll make
Federal Register has not yet seen fit to publish the document. It made it to them many, many weeks ago.
Okay, so they've not seen fit to publish the document. And how many days do we give people to comment?
60 days from when it does.
60 days. But you've had the advantage of looking at it these past 6 weeks because it's on our website. So, and I don't think we're going to change. There's not going to be any changes in the document.
There are changes in formatting that are completely non-substantive.
So please, you guys have all made very important points and a lot of things for us to think about in your points. I was just waiting for that, for the point that Jim made to be made, which is, and I know that Emir has said it has basically exempted pension funds for 3 years or something to that effect. So I was waiting for that point to be made. I'm glad you made it. So otherwise, I'd be very disappointed if nobody had made that point. So thank you again for your valuable contribution and enjoy your weekend. Thank you.